Welcome to Invest Giant. Learn, invest, build your net worth. Today we're talking about building long-term wealth through dividends, and more specifically whether high-yield dividend ETFs or individual dividend stocks are the better way to go. Both options offer the potential for passive income and can be incredibly powerful tools for achieving your financial goals. We'll break down the pros and cons of each approach so you can make the most informed decision for your unique investment strategy. Let's dive in and explore. So, let's start with high-yield dividend ETFs. These investment vehicles have gained significant popularity among both novice and seasoned investors for their unique benefits and potential for steady income. Now, if you're new to investing, an ETF or exchange-traded fund is essentially a basket of stocks that tracks a particular index, sector, or investment strategy. This means that when you invest in an ETF, you're essentially buying a small piece of a large number of different stocks all bundled together in one convenient package. Think of it like a pre-built diversified portfolio that you can buy and sell just like a single stock. This makes ETFs incredibly accessible and easy to trade, even for those who might not have a lot of experience in the stock market. High-yield dividend ETFs, specifically, focus on holding companies that pay out a higher-than-average dividend yield. These are typically well-established companies with a history of paying regular dividends to their shareholders. Now, one of the biggest advantages of high-yield dividend ETFs is instant diversification. By investing in a single ETF, you're spreading your investment across a wide range of companies and sectors, which can help to reduce risk. Instead of putting all your eggs in one basket by investing in just a handful of individual stocks, you're spreading your risk across a wide range of companies and sectors. This diversification is a key strategy for managing risk and ensuring that your portfolio is not overly exposed to the performance of any single company or sector. This is absolutely crucial for mitigating risk and protecting your portfolio from the volatile swings of the market. Market volatility can be unpredictable, and having a diversified portfolio can help to smooth out the ups and downs. Another major benefit is the simplicity and ease of management. High-yield dividend ETFs are designed to be user-friendly and require minimal effort to maintain. With a high-yield dividend ETF, you don't need to spend hours researching individual companies, analyzing financial statements, or trying to time the market. The ETF managers handle all of this for you, making it a hassle-free investment option. The ETF managers do all the heavy lifting for you, selecting and rebalancing the underlying holdings to maintain the fund's investment objective. This professional management ensures that the ETF remains aligned with its goals and can adapt to changing market conditions. This hands-off approach is perfect for busy professionals, passive investors, or anyone who prefers a more streamlined investment strategy. It allows you to invest with confidence, knowing that your portfolio is being managed by experts. And of course, we can't forget about the consistent income stream. High-yield dividend ETFs are designed to provide investors with a steady stream of passive income, which can be especially attractive for those seeking current income or looking to supplement their retirement savings. High-yield dividend ETFs are designed to provide investors with a steady stream of passive income, which can be especially attractive for those seeking current income or looking to supplement their retirement savings. This consistent income can be a reliable source of funds for retirees or anyone looking to generate additional cash flow. These dividends can be reinvested back into the ETF to accelerate your returns through the power of compounding, or they can be withdrawn and used to cover living expenses, pay bills, or even fund your next vacation. The flexibility to choose how to use your dividend income is a significant advantage. However, it's important to remember that high yield doesn't always equal high returns. While those juicy dividend yields might seem tempting, it's crucial to look beyond the yield and consider the ETF's overall performance, expense ratios, and underlying holdings. While those juicy dividend yields might seem tempting, it's crucial to look beyond the yield and consider the ETF's overall performance, expense ratios, and underlying holdings. A high yield can sometimes be a sign of underlying issues with the companies in the ETF, so it's essential to do your homework. Some high-yield ETFs might be invested in companies with shaky financials, or operate in sectors facing headwinds, which could potentially impact their long-term growth potential. It's important to understand the risks associated with the underlying holdings of the ETF. Additionally, keep in mind that investing in ETFs means you're giving up some control over your portfolio. You're trusting the ETF managers to make the best investment decisions for you, and their investment philosophy might not always align perfectly with your own. You're trusting the ETF managers to make the best investment decisions for you, and their investment philosophy might not always align perfectly with your own. It's important to choose an ETF that matches your investment style and goals. Overall, high-yield dividend ETFs can be a fantastic option for investors seeking diversification, professional management, and a source of passive income. They offer a convenient way to invest in a diversified portfolio of high-yielding stocks without the need for extensive research or active management. However, it's essential to do your due diligence, research different ETFs thoroughly, and choose those that align with your investment goals, risk tolerance, and time horizon. By taking the time to understand the specifics of each ETF, you can make informed decisions that will help you achieve your financial objectives. Now let's switch gears and talk about investing in individual dividend stocks. This approach is all about taking a more active role in your investments, handpicking the companies you believe in, and potentially reaping the rewards of their success. Unlike passive investment strategies, this method requires you to be more engaged and informed about the companies you choose to invest in. One of the biggest advantages of investing in dividend stocks is the potential for higher returns. Dividend stocks not only provide regular income through dividend payments, but also have the potential for capital appreciation, which can significantly boost your overall returns. By carefully selecting individual companies with strong fundamentals, a solid track record of dividend growth, and a competitive edge in their respective industries, you have the opportunity to outperform the broader market and potentially generate significant long-term wealth. This requires a deep understanding of the companies you invest in and a commitment to ongoing research and analysis. Another major benefit is the level of control you have over your portfolio. You can make decisions based on your own research and insights, rather than relying on the decisions of a fund manager. Unlike with ETFs, where you're at the mercy of the fund manager's decisions, investing in individual stocks allows you to tailor your portfolio to your specific needs, risk tolerance, and investment goals. This means you can adjust your investments as your financial situation or market conditions change. You get to decide which companies you want to invest in, how much you want to allocate to each stock, and when to buy or sell based on your own research and analysis. This level of control can be empowering and allows you to take charge of your financial future. Furthermore, investing in dividend stocks allows you to align your investments with your values. You can choose to support companies that are environmentally conscious, socially responsible, or operate in industries that you believe in and are passionate about. This can add an extra layer of satisfaction to your investment strategy. You can choose to support companies that are environmentally conscious, socially responsible, or operate in industries that you believe in and are passionate about. This alignment can make your investment journey more fulfilling and meaningful. This level of personal connection with your investments can make the entire process more meaningful and rewarding. Knowing that your money is supporting causes and companies you care about can provide a sense of purpose and satisfaction. However, it's important to acknowledge that investing in individual stocks comes with its own set of challenges and risks. It's not a guaranteed path to wealth and requires careful consideration and management. First and foremost, it requires a significant time commitment. You'll need to dedicate time to researching companies, analyzing financial statements, understanding industry trends, and staying up to date on market news. This ongoing effort is crucial to making informed investment decisions. You'll need to dedicate time to researching companies, analyzing financial statements, understanding industry trends, and staying up to date on market news. This can be a continuous process, as market conditions and company performance can change rapidly. This can be incredibly time-consuming, especially if you're managing a portfolio of multiple stocks. Balancing this with other responsibilities can be challenging, and it's important to be realistic about the time you can commit. Secondly, investing in individual stocks carries a higher level of risk compared to ETFs. The performance of your portfolio can be more volatile, and individual stocks can experience significant price swings. By putting your eggs in a smaller number of baskets, you're increasing your exposure to company-specific risks, such as poor management decisions, increased competition, or unexpected industry downturns. These factors can have a significant impact on the performance of your investments. These events can significantly impact the performance of a single stock and potentially lead to substantial losses. It's important to be prepared for this possibility and have a strategy in place to manage these risks. Finally, remember that dividend payments are not guaranteed. Companies can choose to cut or even eliminate their dividends altogether if they face financial difficulties, experience a decline in profits, or decide to prioritize other uses of their cash flow. This can affect your expected income from these investments. Companies can choose to cut or even eliminate their dividends altogether if they face financial difficulties, experience a decline in profits, or decide to prioritize other uses of their cash flow. This can be particularly challenging for investors who rely on dividend income. This can be particularly devastating for investors who rely on those dividend payments for income. It's important to have a diversified income strategy to mitigate this risk. Ultimately, investing in individual dividend stocks can be a rewarding strategy for those who are willing to put in the time, effort, and research required to succeed. It offers the potential for higher returns and greater control over your investments. However, it's crucial to approach it with caution, diversify your holdings, and never invest more than you can afford to lose. By doing so, you can manage the risks and increase your chances of achieving your financial goals. So, there you have it. A comprehensive breakdown of high-yield dividend ETFs and dividend stocks. As you can see, both options have the potential to be lucrative investment strategies, offering unique benefits and opportunities for growth. However, each comes with its own set of advantages and disadvantages. The best choice for you will depend on your individual financial goals, risk tolerance, time commitment, and investing style. If you're looking for a more passive approach with built-in diversification and professional management, high-yield dividend ETFs might be the way to go. These funds offer a hands-off investment strategy, allowing you to benefit from the expertise of fund managers. But if you're willing to put in the time and effort to research individual companies and potentially reap the rewards of higher returns, then investing in dividend stocks could be the better option. This approach requires more active involvement and a keen eye for market trends. No matter which path you choose, remember to do your due diligence, thoroughly researching each investment opportunity. Invest for the long term, focusing on sustainable growth and stability, and never stop learning. The world of investing is constantly evolving with new trends and opportunities emerging regularly. So staying informed and adapting your strategy as needed is crucial for achieving your financial goals. Now I want to hear from you. Let me know in the comments down below which investment option you prefer, high-yield dividend ETFs or individual dividend stocks, and why. Your insights and experiences can help others make informed decisions. Happy investing!